Good morning.
Good morning, everybody.
I want to thank you for this opportunity to talk to you about this exciting time, and I do want to thank NYSRA for allowing us to actively participate in the transformation project. It's been exciting in phase 1, and I look forward to further work in phase 2 and really help organizations figure out where they might want to be at the end of the day, because every time we realize and learn something new with the field, we know another segment's changing. And if you had the opportunity to listen earlier today, you were able to hear Ann Hardiman with NYSACRA and Michael Searider with NYSRA informing us about the most recent change that will be coming forth with conflict-free case management. So many of the principles will apply, whether it's work center transformation, whether it is changing and moving into another structure or any other segment of your business that you're actually looking at. So I look forward to questions, and we'll see how we can help you in the process, because there's much to consider when you're looking at changing how you do business.
And the idea of today's session is to generate questions and have you start thinking a little bit out of the box, as the title of the session is Identifying Creating Corporate Structural Changes. As Lori said, we've worked with a number of providers, very, very interesting process, but what we found on an overarching basis is a lot of people are stuck in their ways that they don't want to change, and we really need to start thinking very, very differently. We need to think with a for-profit mentality, even in a not-for-profit business that we're operating. As we worked with these not-for-profits and looked at their models, many of the items that we were focusing in upon did not make sense in the for-profit world. One thing that is overarching in terms of the process would be we do have to think about immediate change once you get into things, and the process for making decisions and approval of those decisions is very important. As was indicated at the beginning of the session, I'm the president of a board of a not-for-profit. It gives me a very different view of how to run an organization, working with management, working with the executive directors, pushback that I see as to what the board's involvement should be or not involved within the organization. I get a term called micromanaging quite a bit in terms of how things should be done. But again, the concept would be we need to think about change. We need to think about doing business differently than we've done it before. In the not-for-profit that I do work with as the board president, we've gone through tremendous change from day one when I went on the board, changed processes, changed systems, changed people, and we've gone from an organization that was pretty much almost going out of business to being the center of the community, and everybody asking what could we do next. Staying all in the not-for-profit realm, but just to give you an idea as to where we need to think and we need to go forward with regard to the session here this afternoon.
So the agenda is before you, and we will do just a quick overview of the integrated business models that were proposed or that are in place with OPWDD. I think this whole component started with the transformation agenda and looking at the work center transformation that's taking place. And I just want to briefly review those. While we will be talking about work centers, again, we'll reference back to other examples in the non-for-profit business world that people need to consider as they move forward. And Alan's 100% right. We need to begin to function as a for-profit business, which means making quick, hard decisions that are really difficult at times and really making sure things align with our mission. We will cover considerations for designing corporate structures. Again, when you get into corporate structure design, you must involve an attorney because it involves filing some legal papers. But we will go over some of the concepts and some of the key elements for consideration. We will review various corporate options that may exist, and there's more always being created. So again, opportunity exists to look for other things. We will discuss potential impact of corporate changes and then strategic positioning for the future. I always look at any change that you face on where do you really want to be getting at the end of the day, because you almost need to start with the last bullet first to really figure out where you're going at the end of the day, because right now we may feel that the changes are being forced by OPWDD. At the same time, we must comply and work through all of this and survive and be stronger and healthier.
And the one caveat that I must give, I should have said at the beginning, we are not attorneys. We are business advisors. I am a CPA, as Lori said, a wealth of experience in the industry. So we are not providing any legal advice here today, only business advice and raising questions with regard to what you need to think about.
As Alan brings that forward, he has the CPA knowledge, experience, license behind him. I have, and not that Alan does not, I have some real life experience. I've been involved in buying doctors' practices, acquiring them, moving them into foundations, starting spin-off businesses from healthcare facilities, opening Article 28s, closing Article 28s, you know, you name a business component. I've opened a laboratory and sold that off. So again, many actual business ventures that I've been involved with. So I bring that wealth in addition to the DD knowledge as well. So transformation, again, this is probably old news, and we will just cover this briefly because, again, it's been out there for a while, but I think it's just important that you always have what the goal is at the end of the day. And again, they're expecting work centers to become, OPW being they, inclusive of CMS, are expecting that the transformation is expected to be completed by 2020. When you really look at what the message is, in whether it's Model 1 or Model 2, what the government, and in government I'm talking both New York State and the federal government, they're really talking about really spend time with the person and figure out their interests and figure out if employment's their interest, how do you get them gainfully employed to the best of their ability. So I know there's many competing factors in that. It's easier said than done. For those that are going to be keeping work centers, there are two models that are being proposed. The first one is the workforce is 40% or less consist of employees from who receive OPWDD HCBS services. I'm assuming many of you are providers, so I think the acronyms are well known in our field. If there's questions regarding any of the acronyms anywhere in the process, please don't hesitate in asking. The big component is they're expecting those that are workers in the work centers, and I use the term workers because it should include people with disabilities as typical employees, but that are expecting those with disabilities to be treated and given the opportunities as anyone else at the end of the day. So I know I ran 3 work centers, and I'm talking from personal experience. I can tell you lunch breaks were done en masse. Everyone moved to the cafeteria, and it was for the disabled population, not the other workers in the component. I also know our days were very brief. When I look at a manufacturing plant, and having had some experience, which I was sharing to the various people right before we started, I have worked in a manufacturing plant as a general laborer in my life. The people with disabilities often come in, start about 9 and then have breaks, have lunch, and are usually out the door by 2:30. And 2:30, 3 o'clock. When I worked in a manufacturing center, I knew I had to be in by 8, did not get paid lunch, would usually leave at 4:30, and unless there was mandatory overtime because production had to happen, that's how it was done. So what they're really asking, the state is really asking the federal government, is all employees are employees, whether they're disabled or not, and all must be treated the same. I mean, that's probably the easiest way to describe this. It makes it very complicated when you look at what we actually do every day, and it's really beginning to look at who are employees in the work center versus those that also may get vocational support, such as pre-vocational services as supported employment. So Model 2 is basically the same rules, but you're looking at a greater capacity of numbers of workers that in fact can have disabilities or OPWC services. And this really allows the continuation of the national contracts that may happen, because you do have that 75% threshold of disabled population being supported. As you may know, much of this whole niche, which I know there's a new name now for that, but many of those relationships were created through the waiver, through an act created in 1934, and they're being challenged on the national level. So again, I think much more change, it's the Wagner Act, much more will be coming forward in terms of what can actually be happening in sub-minimum wage situations, piecemeal component, because all of this is being challenged on a major national level, but all the issues have not been dealt with. So.
Right, and this is not just within the workshops, but across the board. Organizations that have hired interns in the past and gotten them pro bono are getting a big realization with regard to the fact that you actually have to pay people. So Lori's point in terms of the disabled workforce, they need to be looked at as non-disabled employees. They need to be treated the same way. One of the big issues that I remember in our beginning sessions that we had attended as part of the transformation project itself was some cases whereby certain providers were penalized by the federal government, that they were talking about people were in a workshop and they were training for 40 years, and at what point in time do they actually become workers as opposed to trainees. So we do need to look at that model. Plus, very importantly, as we're going forward, if you do want your business to survive, we do have to be efficient, we have to be economic, and our employees need to be working like employees. Otherwise, we're not going to be able to produce the product or service, whatever we are going to be doing within this new business model as we do go forward.
You know, one of the things when I was running a workshop, and if I look back at it now in relationship to business, we really made sure that we had work for everybody. And when you think of it, that's a fantastic social model, and it's really important for consideration, and I know many providers actually do this. When I really take my hat off and look at it from a business component, I overstaffed, in reality, the business, thus making the business not survivable, because in fact I wanted to make sure that everyone had an opportunity to be part of the production. So these are some of the challenges you're going to begin to discuss and think about as you begin to look at workshop transformation. It's very hard discussion points. Many people have come to work centers for years, and that's really their social network outlet, and I respect that, and yet at the same time I challenge organizations to think, are there other ways to fulfill the social aspects of life that are not work center based? Just something to be thinking about.
And to just give you an analogy, in New York State there's a major change that has been going on for a number of years in the healthcare industry. The nursing home providers have been hit hard with managed care, with reimbursement implications. They were working for many years with almost a 30-year-old base year that was finally updated, but the update kind of hurt a lot of organizations as part of it. And the trend that we're seeing right now is many not-for-profit nursing homes are selling their facilities, they're selling their licenses to for-profit providers. And then when you follow the trail as they do go forward with regard to running it as a for-profit organization, the first thing that you're going to think of is that the care is going to drop. It might. I'm not going to say that it has or has not, because I'm not the critique of that part of the business. The piece that I see with the for-profit owners is they cut away the waste. And when a not-for-profit organization might have 3 or 4 executive assistants or administrative assistants within a program, everybody has somebody working with them. The model as we go forward is everybody has a computer. I know that Lori and I type our own memos, we write our own letters, we write our own proposals. The concept of people doing that for you is kind of going away. Yes, we do need the appropriate amount of staffing to comply with the laws, the regulations, all the paperwork that we do have to worry about, but when you look at it from an outsider's view as to how an organization can theoretically be run, can we be more efficient? What costs do we not need? Some of those things we're going to be talking about here this afternoon, because you do need to think about that as you go forward. And when, for instance, in a not-for-profit, and I'll bring them up throughout the conversation here this morning, when I look at the not-for-profit where I'm the president of the board, it's a $10 million organization, and they went about, before I came on the board itself, of cutting costs and cutting costs and cutting costs, and we're in a situation right now where I got no more costs to cut, but I now need to generate more revenue. So when you have the mix between the two, there's only so much of that sponge that you could squeeze the water out of, because you have to move forward with it. So as a new model concept, whether it be Business Model 1, Business Model 2, or outside of the box in general, how can we generate revenue? What profitability component are we going to have in there? And yes, I'm going to throw that ugly word out there that we'll talk about a little bit later, the concept of cost accounting. And knowing where our expenses are, what they mean, and what actually goes into a product or a service as of the end of the day.
I know Ellen referenced for-profit and making profits, and I know that's something that we struggle with. And I think back in my healthcare days, I happened to be a hospital exec in a Catholic hospital system, and the nun's mission statement was no money, no mission. So it really comes down very quickly that if you're not covering your expenses, your survivability of your mission is not present.
And the problem is that many for-profit businesses start off with the wrong vision, with the wrong thought model. I'll give you an example of mine that took me 3 hours to get in today, because somebody got killed by a train on the Long Island Railroad. But when I go from where I park every morning to walking to the train where I get on, there's a little, used to be a diner. Seemed to have been in business many, many, many years, was open 4 o'clock in the morning, tremendous breakfast business. About 3 years ago or so, all of a sudden I see a for sale sign. And the business was sold, and there was a new owner that moved in. They changed it from a diner to I believe it was an Indian restaurant. I walk by every morning, I walk by every afternoon. I never saw a customer in the store. Within 6 months, they were shuttered, they were closed, and the building had now been shut down for about a year and a half. About 3 months ago, I see a new group in this diner business. They open up a Spanish deli, and I'm seeing the same trend again. They are no longer open in the morning. They now open after 9 o'clock, and when I walk by in the afternoon or evening, I see maybe one person in the facility, in the restaurant. So you need to think as to what your customers are, what the product is, what the service is, market studies, knowing if it's going to work, and doing a lot of legwork beforehand. The questions that we put on the screen here on slide number 4 is the start of generating the questions that you should be asking yourselves. As a not-for-profit, you might have been in business for a year. You might have been in business for 100 years. And when we look at it, how often have we really looked at our mission, our purpose as an organization? I know that at least when we changed the 990s back in 2008 to the new 990, as we call it, yes, all of a sudden the mission became focused because we did have to report it twice within the 990. And then the concept came out of, well, that's not really what we do anymore. So we do have to make sure that's up to date. We need to make sure that is focused on where we're going. But when we think about it, you don't need to be a provider of every service to everybody. And I think what we've learned over the past number of years with this ever-increasing transition into the managed care world within the special needs organizations is that you do need a specialty. And what is it that we do the best as an organization? What are we most efficient at? As Lori was telling me the session earlier today, talking about conflict-free case management services, throw another wrench into the mix with regard to you can't provide this service if you're providing that service. How are we going to survive and make up those revenues as you do go forward? So the legal mission, the purpose, looking at that, making sure it does conform to what we are actually doing and what we want to do on a going forward basis. So we do have to think about prospective activities, what we think we want to do going forward, and does it make sense within the legal parameters that our organization has been set up with regard to either OPW, OMH, or whatever office that we're working under here in New York State.
One of the documents we often have filed away somewhere in the secure legal files is the Articles of Incorporation or Certificate of Incorporation or Charter. And it's really critical at this time that you begin to pull those out, because that is by the incorporation documents your boundaries under which you need to be operating. And if you begin to move outside of that, you're exposing the board and governance structure to significant liability, and you may not have coverage if you don't think about this. And I know, you know, I was running an organization that has now been in existence 60 years. And what was written at that time versus what we're doing, yes, it may fit, but as you begin to stretch that agenda out further and further, or do spin-off corporations, you need to make sure it's in compliance, or you could be in significant trouble going forward.
And then you need to start thinking about your organization, how you do business right now. How efficient are we? The third bullet on the fourth slide talks about level of compliance with the certificate or charter, your bylaws, more importantly, your mandatory filings, your licensing, corporate compliance plans, and other corporate matters. Are we up to date? Are we efficient? Do we file things on time? I've worked with many not-for-profits over the past 25 plus years, and at least I've seen, at least in the last 3 to 4 years, more compliance with regard to deadlines, you know, with regard to the CFR filings. As an aside, how many years have OPWD providers had a filing deadline of May 31st with one extension or November 30th with one extension, but you file your CFR sometime in December, January, February, you know, all of a sudden this year the state cracked down and said, you know, there are going to be penalties, and even worse, as they go forward, they're implementing in the regulations that if you don't file it within a certain point in time, we're going to cut 50% of your funding. So each of these items do play a very important role, but remember what we said a little bit earlier, we're talking about for-profit models, and implement that part of your not-for-profit world and saying, how do I do things the best way? How do I make sure I meet every deadline? How do I make sure that when I meet those deadlines, the information is correct, as opposed to just filing something which we know we can't do? Then you go into strong and stable leadership with regard to the board, your officers, and then eventually executive leadership. As a board president, I am the chair of the executive committee of the board, and as I know, in working with boards, there's always a few members who are the drivers of the organization, but when you look at your board, have you done an assessment with regard to their capabilities, their compliance, and their expertise within the organization, what they can do, what they can't do? One thing that I've learned over the past couple of years is that every board should, in effect, make up a chart with regard to their expertise that their board members have, look to see what they still need in terms of going forward into the future, because again, the world is changing, and what you had in the past might not be what you need going forward. And in our industries, there's a lot of parents who are very, very involved, which is important, but when you're running a business and when you have parents on the board, you could have conflicting views as to how you should be providing services, what you should do, what you shouldn't do, and the most important thing that we need to think about with regard to that is there should be nothing on the table that is just considered the holy grail that would not be subject to change. So stability of the board, bringing new board members on, and as a board member, what I've seen again is that there are a few people who are very involved in the organization, but where is that pipeline for the future leadership? There is a focus going into the future with regard to board limits in terms of their terms, and to me, I got a little bit of a problem with that because, you know, unless you're a huge board or a self-perpetuating board, it is hard to find members. It is hard to find and bring people onto the board itself. I've gone through a process this year where we tried to expand the board. We actually brought 4 new people on in terms of the formal board membership, but then 2 people dropped off. So, you know, gained 4, netted 2 at the end of the day. So we started a new process in terms of trying to get additional expertise for the organization by having people volunteer not as board members, but gearing them up and trying to get the future prospective leaders in the pipeline as to how we're going forward. Then, of course, in terms of reputation, so employment services amongst your consumers, the patrons, the funders, and other stakeholders, how does your organization fit with regard to other providers? And depending on your organization, a situation in terms of which region you are, I've seen it very, very often, at least here downstate, you might have in a 3-block radius 3 different providers providing the same services, and maybe we do have the population density in order to be able to do that, but we see so many programs that are struggling that just don't have the census to drive the revenue itself. So what is your reputation? How are those services being provided? Are you the best in your area for these particular items?
And when you talk about the reputation, we also need to look at, again, how effective are the program activities. What this is really getting at is the beginning of the discussion on outcomes. So you're doing pre-vocational services for 1 million years. Has the person actually progressed? In reality, are you actually getting people the opportunity to apply for jobs, have an interview, and gain employment at the end of the day? So this is really beginning to have you do those hard questions on, I have 100 people in the work center, of which so many have been in the work center, 20 just less than a year. You'd be looking at moving those out potentially more quickly and really looking at your transitioning through in reality. So that's what you're looking at in terms of the effectiveness of the program activities. It's not really what are they doing and how are they spending their day. It's really looking at, for your habilitation services, are you getting results for the people? So, again, how do you stack up from the overall perspective of your stakeholders, and then how effective are the results that you're actually getting?
And that goes into play with regard to the future focus of many of the oversight agencies in the not-for-profit world. They're going away from ratios. They're going away from admin percentages. That'll be one little factor. But your performance, how do we measure that, and how do we know that we are successful in providing the services to our consumers on a regular, ongoing basis? Now, in terms of some other areas, as I said a little bit before, core competencies, what are limitations with regard to managing and navigating the changing customers, the funding, the regulatory environment, the work center, are we in a growth or declining or crisis mode? Some of the work centers that I deal with are in growth modes themselves, but in terms of looking at them, it all depends on the focus by management and the products that they have and that they're producing.
Going back to the core competencies, one of the struggles work centers are having, excuse me, is, again, if you're supporting both the mental health population as well as the DD population, you may, in fact, with the mental health population, have people that become HARP eligible. And that has rolled out in the rest of the state effective July 1st. So that, in fact, you will be introducing the HCBS services under that venue. So you may, in fact, have people that are HARP eligible that are part of your work center that are also now part of the managed care element. So you need to really begin to understand, are you prepared for these types of things? One of the complexities of being a multi-service provider, while it improves often the output in the work center, is understanding the demands of the OASIS, OMH, the behavioral health elements, as well as DD. And I know predominantly today's focus is really looking at OPWDD's focus of work center transformation, yet I know many work centers do support multiple populations. So you need to be keeping an eye on all of that at the same time.
Yeah, and then, of course, as I said before, that ugly word, cost accounting. So how profitable is each line of business? And we hope at this point in time organizations do have delineation with regard to departments, with regard to each service line, and we can come up with a P&L for each business. But then the question comes down to, is that a fully costed service line? Do we just have, as a lot of people try to look at it, these are my direct costs, these are my revenues, I'm fine. However, you do have to pay for central administration. You do have to pay for other administrative costs within the organization that are to be allocated to your particular business. And when you look at it on a different view, from an outsider's view, you need to start thinking about the question of why are we running this line of business? Does it contribute to our bottom line? Is it essential for the future growth of the organization? Again, in the not-for-profit that I am on the board, we've looked at many of the lines of business. We haven't fully costed everything. That's a project that we're going to be going through for the current year. But what we've identified is that we have certain programs that are just so near and dear to the mission of the agency that we will continue funding them. But then there are other ones that are very similar that we just don't understand why we've been running them at a loss for quite a number of years, and there's no potential to gain profitability within those other lines, and we're potentially going to be stopping them and focusing upon the ones that are more key, and then developing other profitable businesses within the organization.
Within this area, where we need to look at each service business line, within the work center, they're usually a combination of multiple funding streams, and often a combination of many products produced. So you may have a janitorial service line, you may have a manufacturing line, you might have an upholstery line, you might have a shredding business, you might have a kitchen. I mean, each of those are different businesses within the product line. So not only within the product line do you need to look, you need to drill down into each of these different products or businesses within the work center line to see if those businesses can sustain and hold up. In addition, we have blended habilitation revenue within often many of these products. So one of your first points of really beginning to separate the habilitation expenses to see if the habilitation services are running at a profit or loss. And then, can the business sustain if the habilitation service is not part of that? You really need to begin to look at habilitation separate from that core business and see if your pricing structure really supports itself to really get to the end of how do we sustain and keep that business going.
And then, of course, vision. So where do we want to be in 1, 3, and 5 years? Do we have strategic plans? I know they're tough to prepare and do take quite a bit of time and effort by everybody in the organization, but updating strategic plans is very important. We do need to focus upon where we view the organization ultimately, because we know where we were 5 years ago, we know where we were 10 years ago, and if you do a look back, you are not usually very similar to where we were because of all the changes in reimbursement models and programs and new programs that have come on board over this period of time. So again, focusing upon where strategically we do want to go and which programs are appropriate. I've developed a committee that is looking at strategic growth within the not-for-profit because when we looked at certain things, for instance, we have about 100 programs. 97 of them are pretty small, which do generate some revenue, but our 3 large programs in the organization, one of them is actually a camp. Camp does produce a profit. It is a profit center, but we were scratching our heads last summer when we added 100 kids and we gained no profitability within that service line. So we came down to the fact that our budgeting within the program could have been better. Our oversight by our director within that program really needs to jump on it much quicker. But when you think about it, as was explained to me, a camp program happens in about 8 weeks. So you have to gear everything up in the last couple of months right before it. You have 8 weeks. You pretty much don't get much in terms of the P&L during that period of time. And then whatever happens, happens as you do go forward. So very importantly, we do have to make sure that if there is a product line that we are going to expand, profitability is there, what costs might be involved in it, but again, 3 to 5 years strategically going forward. And then very, very importantly, motivation. So do we have a strong motivation? Do we have a strong desire to do what's needed to be competitive, including doing business differently? So while we might have done things a certain way for many, many years, we do need to think about changing those processes. We do need to think about working differently, and as I said a little bit earlier, Can we work in a for-profit environment whereby we can work more efficiently but cut the costs that should be cut as opposed to hurting our performance and hurting our services to our consumers on a going forward basis?
The key element of the strength of motivation is you are going to be into some hard decisions. And you will have people not on board. I mean, I will honestly say that. And if your motivation's not strong enough, it's very hard to get through these pain points. I was fortunate to have been created an Article 28 clinic that really supported not only the behavioral health needs and the medical needs of people with disabilities, but it really was the stronghold in the community for many of the supports throughout the Hudson Valley region. We, however, were losing over $1 million a year in this operation, and yet we were doing a phenomenal quality job. And when you really began to look at this, it really became down to, yes, the patients love the service, the providers love the service, it's high quality, everyone got all of the components of paperwork they needed. But in reality, the organization I was running was carrying the cost of supporting many other organizations and providers and never able to recover that. So we began to look at the long term, can we sustain carrying this and what is the value for that? And at the end of the day, we decided we could not support the community to a tune of $1 million, and we're able to find a partner to be able to transfer the services whereby we did not carry the burden. So hard decisions, a lot of debated discussion at the board, at the operations, to the clients, and at the end of the day, we were much stronger because we were able to effectively transition that business.
So some key financially related questions that you need to ask yourself, and a lot of it is available right now through cost reports or your financial statements. What are the revenue mix and trends that you're experiencing? Are we trending upwards? Do we have certain programs that are trending the wrong way? Very importantly, how stable are the contracts that we have? So are they ongoing? Do we have potential for them not to be renewed in terms of the funding themselves? Different programs seem to end for certain reasons. Other programs start. For instance, we got a lot of these balance incentive program grants going forward, some vital assistance program monies that are one-time funds coming through. So again, stability of the contracts that we need to understand. And then as you go into a merger, what are the views of your donors? Because if you do have a good fundraising base, which is hard, but it is very important on a going forward progression in terms of operations, if you're going to change your way of doing business, if you're going to change the affiliation or you're going to merge into some other organization, will those donors go someplace else? Will they not want to fund you as an organization? I know many, many times at the board level we have a discussion with regard to maintaining the organization shape and form that we have right now. Otherwise, a number of our donors just don't want to support the organization. So we do take that into consideration with all the changing demographics within the communities. So
going back to the revenue mix and stability of contracts, again, having run a work center before, there were some jobs that really supported many people that we were providing services to. And the clients loved the job, and there were many almost everyone with various levels of disabilities could in fact work on this various assembly line. Yet, and the contract was very stable, yet at the end of the day, when I looked at it, there was no way that the pricing was effective to cover the expenses associated with that contract. So yes, we need to look at the stability of the work center contracts, but we also need to look at, are they covering the expenses associated with that? So it's really critical that you delve into each of those revenue aspects that is affiliated with a work center when you want to begin to look at how do you change the model.
Some other questions: what is your net worth? Liquidity within an organization, so what is your cash position? Short-term and long-term. And there is a new model coming forward with regard to financial reporting for not-for-profits that will enhance this reporting in a number of years. We're still working on some of the details on that, but we do need to carefully see what liquid cash we have, what ability we have to pay our bills, credit lines, what's the history of use and for what reasons, and can we cover our pure cash flow or support deficits as we do go into the future.
One of the, in my healthcare administration days, one of the key slogans was cash is king. If you don't have cash, you can't pay bills, and it costs money to have lines of credit and or people extended. We in the DD world have been, by and large, somewhat protected from the concerns of cash flow over the history when I think of the years. When I was in healthcare, our accounts payable usually ran about 120 days. And that wasn't considered bad. I came to the DD world and we were dealing 30 days. And if I think about it, as our margins become tighter and the profits, or margins decrease, cash is going to begin to shrink. In addition, anyone that is supporting the mental health population that is quickly, or the behavioral health population that is quickly moving into the managed care, you will have cash flow that will slow down with HCBS service payments. So it is absolutely critical that you begin to look at your cash flow ability today, where you're really standing, and begin to assess, in fact, are there vendors you're paying too soon? That may sound foreign to you, but if the terms of payment really are 90 days, why are we paying vendors in 15 or 30 days? Cash management will be an absolutely critical element going forward, and if you manage it correctly, the lines of credit can be minimized as well. So it's really beginning to learn some of those elements that we've really never had to talk about in the DD world. But when you get into offloading your work center into a different business and potentially a different corporation, I can tell you, you will be managing cash.
And as an example, how many providers on the phone, as a rhetorical question, have been the beneficiary of the ICF rate methodology, where you've been accumulating cash for many, many years, then all of a sudden, sometime late last year, the state said to you, we're going to be recouping this en masse, and if we don't get it paid back within a certain period of time, write us a check, otherwise you're going to be paying us interest. So those free loans that organizations have had are kind of drying up, where you have, due to whatever organization on the books for many, many years, while that is a liability, there needs to be cash behind it, because eventually the governmental agencies will be coming back to take those monies. But as Lori said, we do see in the managed care world significant shortages with regard to cash flows and how we need to operate them on a going forward basis. Now, in terms of some other questions, we do need, again, cost accounting, allocation methodologies. Are they accurate? When was the last time we did look at them? What is the basis for those methodologies themselves? I've just gone through rounds of cost reports. Seems like every 15 days a different type of cost report might be due, whether it be the CFR, whether it be a nursing home cost report. We just had long-term programs, the certified home health care programs are coming up, the ambulatory health facility cost reports are in September. So there's always something that needs an allocation. And when you're preparing the cost report is not the time to look at the methodology. If you have a square footage methodology and you haven't looked at square footage in 10 years, it's not acceptable. But it also could be construing the numbers in the wrong way with regard to your programs. Administrative overhead percentages, while they're less of a focus, if we do have a significantly high percentage of overhead costs, how are we able to fund those on a going forward basis? Programs and activities that generate a true profit or loss with the full costing, as I indicated on the last slide, and which all goes into methodologies and philosophies within the organization. So compensation practices, salaries, benefits, what are we providing to individuals? Do we just keep on increasing, for instance, amounts that we're putting into pension plans? When was the last time that we looked at our health insurance? And yes, I know many organizations have been experiencing significant increases in their health benefits. The question comes to participation by employees. What should the organization cover? Do we lower our plans with regard to those particular items, and how does it impact our going forward ability to provide the services within the for-profit or not-for-profit arena?
Yes, Ellen has gone through these. I want to think back that you may be considering, do we close our work center and make it a standalone business? And part of the issue gets to be, you really need to understand all of these cost elements, because these cost elements have an impact whether you keep it within your organization or whether you move it out of your organization. And the impacts, I know on the next webinar when we get into some of the details, we'll be talking about what is the cost of fixed cost carryover component. So it's things that you need to be considering. It's also relevant when you begin to look at the changes with MSC. There's a square footage component that they're having. Right now, yes, it's probably, MSC does not have property included in it, so somehow it's included within your overall structure CFR reporting, and it's really understanding where that lies, because once that changes in a corporate relationship, you need to determine, in fact, are there carrying costs or not, and does that then get triggered back to the organization. So that's some of the areas that we'll be touching base on, but there's just a lot of different factors to consider.
And then what is your impact on administration? So if your workshop is out of the corporation, we're not funding administration for the main company. How do we make up for those differences? Do we need all the administration that we've had before? And we're going to have a more lean model with regard to both types of services that we are providing or within each type of organization.
The other thing is to look at your lease and mortgage obligations. And again, those are documents we probably have not looked at in years and years and years. If you've been operating a work center for 50 plus years and it's been an ongoing situation and you've had bonds covering it, are there covenants that are not going to allow you to use that property for another purpose? Are your leases restricting components? It's really do that homework behind the scenes so that you don't get an aha surprise at the end of the day when you're actually transitioning a business.
Yes, and tax-exempt bonds have strict requirements, significant compliance timelines. They talk about 30 years plus 3 years if you have a 30-year bond that you would have to actually use that space for the particular purpose involved. And sad to say, the IRS does have a division who's going out and auditing these types of programs to make sure there is compliance, because the government seems to be giving out more and more of this type of funding that might not be for the purpose that it should have been used for.
As I sit here and reflect, we are going through a lot of material, and it's areas that we've never, you often don't talk about in the operating of the business, day-to-day operation. It is really often material and information that's kept in finance or elsewhere in the operation. I think that the key thing when you look at all of this is begin to pull out all of these elements so you have a fresh knowledge of what are those restrictions and or issues that may affect you carrying forward, so that no matter what you do with your business, you really have a common understanding, because it's going to be a starting point no matter whether you collaborate, whether you get into partnerships in the future, whether you close a business segment, whether you create a new corporation. They're just essential elements because there's considerations that you need to be thinking about all along the way that we often don't stop and look at.
And who are the people that need to be around the table? So do we have the right individuals with the right knowledge to help us make these decisions that we need to make? So just as a recap on a lot of things that we've talked about so far here this afternoon, decisions that need to be made. Again, where does the organization want to be in 1, 3, and 5 years? Does the organization have the desire to compete in a for-profit business environment? I think everybody is getting the flavor of what we're seeing out there, and that it is a different type of an environment, and we do have to be able to make quick decisions, change course as necessary, but a very big focus on efficiency and that bottom line. Does management and the board possess the skills necessary to navigate a for-profit business and a separate habilitation revenue stream within the organization? And you'd be surprised that you might have a lot of expertise on your board that you were never aware of. Look back at your board members, see what type of environment that they work in their lives. Are they owners of businesses? Are they COOs? Do they operate in an environment that they are dealing with this on a regular basis? And a number of times I go to board and you try to explain to them, well, this is the not-for-profits, that's how they work, and they kind of look at you quizzically and say, but that's not a business, and that should not be how things are done. So you might be able to rely upon them in terms of moving all of this forward, which might be a very big help. in terms of the for-profit business, and again, what type of separate habilitation revenues you might have.
When you think about the work centers, they really have been a production center that has sales associated with it, and they've had a habilitation revenue component. So again, what you really need to step back and think about, do you want to be a business that creates jobs for people with disabilities? Do you want to be an organization that prepares people with disabilities for employment? Or do you want to be a hybrid component of that? Because, again, we often just commingle all of this. Having work available for people does not mean you as a provider need to create the venue under which they work. It really means if you're going to create the venue under which you work, that business needs to be able to stand on its own, but you can still be a provider readying disabled workers for employment. And it may be your employment opportunity, but it may be a community-based employment opportunity. So it's really beginning to differentiate those elements so that in fact you can determine as an organization what is your core purpose when it comes to employment. And, you know, often what ends up happening is what I brought up before, and it has to do with you overstack the FTEs associated with the business production because you want to make sure everyone has an opportunity to leave with a paycheck at the end of the week. And in reality, you need to begin to please both masters of making that business work and then determine really how many disabled workers are you going to be supporting in that business, or do you really not do a work center venue and really just create outside business opportunities.
Very good point. So what areas of the organization work the best? And I think we all know, we might not want to focus in upon it, but what parts of the organization need assistance. So if your back office in terms of accounting and timing of reporting and filings is not 100% where it should be, that really needs to be fixed before we can move forward. If there's a corporate compliance department that's not fully efficient, not looking at things, we need to put more resources in there. And yes, I'm talking about spending money. It might be necessary, but we do need to make sure that each of the components of our organization do work efficiently, effectively, and work with each other in order to make sure that the organization is as efficient and effective as possible in order to move forward with either the work centers or for-profit business or not-for-profit business, because even in a not-for-profit, you know, I've used this terminology quite a bit now lately. A 501c3 is not a business philosophy, it's solely a tax-exempt status. But I go to many, many boards and they say to me, well, as Lori said before, no, we can't make a profit. So we do have to think about that, and we have to make sure that even in a non-for-profit organization, we are profitable and we can develop resources to continue growing and providing those services into the future.
Whether you're moving your work center to a for-profit business or a non-for-profit business, yes, there's a lot of issues that can work through, but the considerations by and large are the same no matter whether you go for-profit or non-for-profit. Again, I think I started off with the corporate structure is not really the end game. It's really all of these other elements which will drive your answer for your corporate structure in reality. So again, what's your mission? What's your governance structure? Do you have access to working capital? I think we talked about cash flow. You spin off your work center that has now been being supported by your agency. Is there access to cash that you're accustomed to? What are the tax and liability considerations? What is the impact on the CFR? Because your decisions will have an impact on the CFR going forward. Are there human resource considerations? And last but not least, if you spin the business off, is it fiscally viable? Right now, we often rely upon the agency to pick up the fiscal viability to make it work. And if it is to become a standalone business, you may not have that luxury going forward.
Right. And the trends that we're seeing is less revenue within these programs. So as you're thinking about strategic planning, where we want to go, whether it be a business plan, we do need to think about carving out state-funded dollars out of there, and what other additional dollars can we have coming in through the business itself. And you know, we can't really rely upon, depending on the structure, the parent or an outside organization to help fund the model. Plus, again, thinking about what the impact might be if we spin off a business to the main corporation, and do we have viability there if we're carving out 10%, 30%, or more of your programs and spinning them off to a different corporation. So, getting into corporate design, again, we're not attorneys, but we do want to talk about the different type of designs that might be out there. Again, as we said earlier, legal counsel is essential for implementation. I've been through a number of these processes already. Every time that I sit in the room with the attorneys, I learn a little bit more about their thinking about something that, you know, as a CPA, I might not be considering in terms of the legal world and the impact on it, plus all the different laws related to whether it be taxes or the like. We do have to worry about those types of items.
What we often find when you're looking at corporate design, it's really a partnership between attorneys and CPAs, because CPAs look at one segment while attorneys look at another, and not that both aren't examined simultaneously. There's an area of expertise that each has, and it's just critical. You usually end up engaging both parties to really get the ideal structure overall at the end of the day.
As an example, I was working with an organization. They were one corporate entity. All of a sudden in their mind they wanted 6 corporate entities. They were not thinking about the additional burden on finance, on reporting, on executive management.
On boards.
On the boards, yes. That's a major item that you do need to think about. But when we are expanding our corporate structure, does it make sense, and what implications might we have? As an example, let's say one of the corporations, because we're really good in our finance department, on our executive management team, is we're going to go into other not-for-profits and we're going to run their back office. Well, no, you don't realize that that is unrelated business income. You need to incorporate a 35% tax rate within there. Is it now profitable at that point in time? So we do need to worry about, as we are going about implementing, costs related to it and other items outside the box that you might not normally think about there. So there are a number of structures that we potentially can be thinking about, whether it's a subsidiary corporation, a related corporation, or a separate corporate entity. Each particular component does have an impact on how we want to go forward. So a subsidiary corporation, that's where we do have a parent-child relationship, and the parent will control the child corporation itself. Usually the term of art within the bylaws is sole membership, as we do see it. Those will require a consolidation of the financial statements. If we do want to report standalone to the parent, there are certain items we have to worry about with regard to financial reporting, but that parent-child structure is quite common. Full control by the parent of the subsidiary corporation. A related corporation is where we have more of brother-sister corporations, whether it be a membership corporation or some governing interest, but there's no control. We might have similar board members, so it might require a combination of financial statements as opposed to a real consolidation. But who has the oversight of each individual entity? Where do they fit within the corporate puzzle? And who has the rights with regard to overseeing them and making the correct decisions? A lot of times that is the appropriate methodology of going forward, or should we have a full separate corporate entity? This is an item that has been discussed over many years, for instance, with regard to foundations, where many not-for-profits have said, well, let's set up a separate foundation, and when you get into the legal ease of this, it's not that easy at the end of the day. And if we do have a fully separate corporate entity, no type of attachment whatsoever, Things that we have to worry about are runaway boards, and all of a sudden we have this great profitable entity because we've done an awesome job at the end of the day, and we're making money hand over fist, and that board says we don't want to be a part of you at all. So you just lost all the effort that you had gone through. So we do have to worry about that, whether there's a catch to keep them in. But again, that discussion really needs to be done a little bit later with the attorneys to make sure that everybody is on the same page. The corporate design is not the first question that you should be asking yourself. In terms of limitations on corporate development, we do have to think about the governing structure. So as was pointed out, if we have multiple organizations, we have multiple boards, we have multiple personalities that we have to deal with. When you do run multiple corporate structures, and I've been blessed with working with a number of organizations, one of them, the organization just keeps growing and growing and growing, acquiring additional affiliates, and then at one point they came to me and said, you know, we prepare every other day in the month for a board meeting because we have so many boards that we need to report to. What could we do? So they went to a combined board structure. They have consent agendas with regard to the board meetings themselves, but then they realized, oh, we're still filing 4 or 5 CFRs. We have all these 990s that we have to process at the end of the year. And then eventually they moved to a corporate structure that combined everybody in, so merged all the entities together except for 2 of them, and making sense with regard to what those 2 entities, those separate entities will do. So you do need to worry about that structure in terms of governance and whether or not you have enough resources of people who want to volunteer within the environment itself. We do have to worry about debt covenants on current capital restrictions and properties that we have right now. So if there is going to be a change in the corporate structure, will there be an impact on the balance sheet? Do we have ratios that we need to maintain? Never mind accounting principle changes that might impact you going into the future with regard to things like lease accounting. But we do have to worry about if we don't have all of that rolling up, how does that impact us on our balance sheet, and can we still meet our bank or financing institutions' requirements at the end of the day? Things like property restrictions, you know, those are very straightforward. As providers, we've signed up, whether it be recently or years ago, we're going to operate a program for 30 years, 40 years, whatever it might be. We break them or we don't comply with restrictions. There could be impacts, so we do have to worry about changes within corporate structures in terms of property restrictions, and then also on the flip side, licenses. Because as Lori and I have seen, it is not always very easy to transfer a license. A number of times, as we've experienced, when an organization is looking to do something like this, the state has come back and said, okay, you give up your license and you then jump into the pool with everybody else to see whether or not you're going to reobtain a license in a different manner to provide those new services. So
Absolutely.
You do have to think about that as before you do any changes or give up anything within your corporate structure. Access to capital. You know, do we have it available in terms of growth with regard to funding or startup costs? Because a lot of times the new businesses might need quite a bit of capital to get them up and running.
And one of the key things truly, and yes, you can get all this other stuff done, but you need to be nimble and decisive in the business venture. Because if you can't really make those quick, hard decisions that are appropriate, you really can be draining the overall entity. So it's really critical that you begin to be quick on your feet and making those critical decisions that have to be made on a timely basis.
Yep. So understanding the corporate structures themselves, just a little bit of an inkling within there. We have regular corporations, so C corporations, S corporations, things like that. The advantages, the owners do enjoy a limited liability for certain business debts, judgments, and other liabilities. In a C corporation, the corporation does pay its own taxes. So when we think about that, if that does roll down to some other investor, there could be double taxation. LLCs are a very interesting animal. There's a number of different be out there, but profits and losses can be allocated to owners along the different lines of businesses. The LLC itself will usually not pay its own taxes, but what will happen is it will flow down to the individual corporations who are the members of the LLC. If we have a single member LLC, then it kind of gets disregarded. We don't have to worry about it, but we do have to worry about tax implications with regard to the corporate structures themselves.
Again, when you look at all the considerations, I think we've made it very clear that it's not the exact corporate structure that matters. It's going through all the strategic considerations. And it really gets back to what do you want to be at the end of the day? And how do you really focus? So going back to your mission and making sure it's aligned. You need to make sure you define which populations need to be supported. And as I mentioned before, many of the work centers support not only the disabled population, but the behavioral health populations as well as the general workers. And as you moved into an integrated business model, that's even going to be more so. You need to really define your scope and purpose of employment services. You know, that is absolutely critical. Are you basically the manufacturing industry that supports people with disabilities, or is your focus really doing job training, skill development, job placement? You know, so you really need to do that soul searching to determine what is your role in employment. Complete a whole SWOT analysis for employment services, and that's the strengths, weaknesses, you know, opportunities and threats. So it's really looking at how can you really make sure that you're as strong as possible in many areas. You need to analyze funding opportunities for each service and then determine the business venture alignment with strategic direction.
So the SWOT analyses are very important. I know that's old school. A lot of people think of it that way. But when we are looking at the different parameters on the going forward basis, it will bring out a lot of items you need to think about. And a lot of times with regard to these strategic considerations, the concept would be put a group in a room, do a number of brainstorming sessions, figure out where you think you might be able to go with regard to the business itself, with regard to the lines of business, with the structure, with your ability to lead that type of an organization or multiple corporate structure organizations themselves. Analyzing the funding opportunities for each service. And you know, we've touched upon this a little bit during the session here today, but I do want to point out and strongly focus everybody who's listening to the webinar this afternoon that when we are making our strategic models and decisions, we can't continue to rely upon state dollars. We do have to make these types of lines of business standing on their own. They do need to generate their own revenues. There might be a little bit of startup funds with regard to these types of items, but they do have to be looked at individually. And when you're looking at that model, very importantly, we need to think about startup costs. We need to think about ongoing operational costs. I know of an individual a couple of years ago, they decided that they were going to quit their job and open up a business. Business lasted a whole 11 months. And you might say to yourself, that's pretty sad, but the truth is, at the end of the day, it was the best thing for the business to close because it was not viable. The reason was the individual looked at their budget. They had a startup budget, they had an operational budget, they had only a certain amount of cash funding that they had, and eventually they did ask for more but realized that they weren't going to take it. But they spent way too much money on the startup phase. They actually spent 2.5 times the amount of the budget that they originally planned, and they had no additional funding to fund the ongoing business. So they struggled for actually the first few months they were doing okay, but then after that everything went downhill. The cash wasn't there, they couldn't put product on the shelf, and at the 11-month period of time they did close. And thank goodness they did have what was termed a good guy clause within the lease, that they were able to pay 3 months worth of rent and walk away from it. But I give you these war stories and experience because when you're getting into these new ventures, we are on our own, as opposed to when OPWDD says, okay, let's come up with a new type of funding, give me a budget, we're going to give you those dollars, work within the limitations. But as we've learned over the years, the providers who jumped in early into new programs usually had decent budgets, had opportunities to make profits. And then later on, as the additional providers came in, the budgets got tighter, the funding wasn't there, and the profitability wasn't there. So a for-profit business is a very, very different animal than anything that we've experienced in the not-for-profit world. If we're a sole OPWD provider and have been in business for, let's say, the past 20, 25 years, you've experienced, as we term, super trends within certain programs, 6+% trends each year. I know they don't happen anymore, but those years were wonderful, and additional monies that we were able to spend on programs, and anything you needed, the state would give you. In a for-profit venture, you're on your own. You do have to make sure that the business does align with the strategic direction, and as we've talked about quite a bit during the conversation here this afternoon, the ability to change, the ability to move in a different direction that you might need to in order to obtain the profitability, to change that business line. Split-second decisions need to be made. So therefore, if you work under your own, your old ways of business, that okay, we have a budget, we have a thought process, we have to go through the executive leadership, we have to go to the board, and again, I'm president of a board. I know how long it does take. For the time an idea comes up from my CEO, comes to me as the board president, we put things into place, might be 2 or 3 meetings before we actually do make a decision for that particular item. Running a for-profit business, you do not have that luxury in terms of doing that, so strategically those considerations are very, very important.
Alan?
Yes.
We do have a question. This is Jill. I think it might be relevant at this point. The question is, we rely on pre-vocational revenue to break even on our workshop today. This amounts to $500,000 per year. Is it okay to include the revenue, although recognizing that this revenue source will continue to decline over time, to assess whether we would be a viable, competitive, stand-on-its-own business?
Again, I go back to it's an element that you may have for a period of time. If you're going to make it a standalone business that is not part of your formula, the question gets to be, is it really then become community-based pre-voc, or is it really an integrated model pre-voc? Community-based pre-voc will continue to be available, but the requirements that take place in that. You have a size limitation, all of those components within the business. I strongly encourage that you separate and truly separate those two out, because the business may not survive. And what you need to be looking at then is what's the time under which, if you're considering that pre-voc as part of the revenue, what is the time you're actually going to have to look at closure and ceasing that business, because the enrollment numbers are going to decrease over time. And if the business can't be viable right now, is there anything else you can do to make it viable to do a carryover component?
What we've seen in certain models is that the funding was carried throughout and increased actually. So the concept would be potentially in the first couple of years something might be there. But definitely over a 5-year period of time, you do have to focus upon no funding through the government as part of these pre-vocational dollars or any of the dollars from them.
So it may give you time to do a transition closure plan in reality if the business isn't viable, because you just need to understand the impact to the overall organization by carrying it. Yeah. Great question. Determine, again, look at your board. It's very critical that you do this at this time because your board really needs to begin to have a business sense, and this is whether you're in work centers or not, because they really need to understand the cushions, and I'm not trying to be negative that, but we used to have the ability to appeal when we were in trouble. And again, I think Alan brought up the trends, and we know we're not seeing that anymore. We know we're moving into managed care. So I don't see the world getting any easier. I do see it continually getting tougher. And in reality, you need the board strong so that you can really hash some of these things out at the board level. If you're going to be keeping and moving into a separate work center business, it doesn't hurt to have a business advisory council to really begin to get you up to speed to really look at running a sustainable for-profit business venture. And many of the communities have people that are willing to participate on a limited basis, just focusing on that, and they will throw questions to you that we're not used to considering. So it's just something to really think about.
Yeah, and just some other items that we've been dealing with and working on, things like cost reporting. Mm-hmm. So as we know, if you're a filer of a CFR, and you do have multiple corporate entities, the state does want each affiliate embedded within the CFR, therefore ratio value of your administrative costs gets allocated. If we do have a related entity and we do have to allocate administration into there, is there any possibility of profitability? We've actually helped write a white paper with regard to these types of items. We're having further discussions trying to carve that particular item out. I did have a process over a couple of years where it seemed that every time that a CFR was filed for a standalone entity, the state would come back on desk audit and ask if there are any affiliates. If there are, please embed them in. So that could impact you tremendously in terms of this particular item. And you know, when we're thinking about these things, just in general, again, increased funding from the state, more standing on your own and making sure that all of the parties that are involved are fully focused on making sure that this does succeed. The board will be an area of strength. They will help you with regard to their expertise and their own experience in their work lives and what they've done over the period of time. I would use as much of that as possible. Make sure that when you do find an individual who has a successful business, try to understand the essence of why they think they were successful and really delve into it. Because again, it's sad to say most organizations that start for-profit businesses, the for-profit businesses do not have a good track record with regard to viability or staying in business. And you know what? I talked about a number of places that failed, but I'm going to tell you there are plenty of other places that grow tremendously. So we're not gonna just be negative in terms of that aspect. But with the right ideas, with the right focus, with the right individuals who can strategically look into the future and understand all the components of that particular business venture, these can work very, very well. I've seen a number of them that do generate quite a bit of profit. So it is very important. One thing that we learned early on in the transformation process was we saw a film about, I believe it was the Arc of Indiana, who was going to be putting up a hotel, a Marriott hotel. And interestingly enough, the percentage of disabled workers, I think it was about 30%. I could be wrong, but I think that's what the number was way back when we heard about it. So think about that in your business. So you're not going to have 100% disabled workers. You're going to have a component of everything. As Lori said at the beginning of this discussion, you know, everybody can't go to lunch en masse. You know, think about your offices. This one goes out. This one covers the phone. This one covers that. So it is a very different environment in terms of operating that standalone for-profit entity.
So we open this up for further questions if people have them. We're in exciting times, definitely.
So again, this is Jill. If you have a question, there are quite a few people on the webinar. So if you have a question, raise your hand and Nicole will unmute you, or you can also type your questions into that question panel. Okay, we do have a question that was just typed in. We are under the impression that since we are site-based, we would need to remain site-based and not be allowed to switch to community pre-vote simply in order to capture additional revenue. That being said, we are also under the impression that once our model 1 is approved, if it is to be approved, we will be allowed to bring folks in with disabilities, particularly to keep the 75% disabled ratio for set-aside contracts with NYSED. Why wouldn't we be able to include that pre-vote revenue?
Model 1 does not allow the 70% component, if you think about it. I think that, I'm going back to that slide, Model 1 is a 40% component. So you could keep the pre-vote there. Model 2 does allow up to the other component. The big issue will be really treating all employees the same. So if they're looking at Model 2, you could potentially include the pre-vote. It just becomes, again, that truly is a different revenue stream as not part of the business. So that's why I'm strongly saying if you're looking at moving the business out, you really need to be looking at should you continue in that venue. So it's complex. Just understand your costs associated with habilitation services and your cost associated with the model. So Model 1 is only 40% of the workforce being disabled. Model 2 allows up to 76% disabled.
We have another question that was just typed in. Can you clarify whether site-based only can be a community pre-vote?
If I could have a further exploration of what the person's asking, that would be helpful.
Yeah, have you only typed part of your question in? Because it looks like it just broke off.
Mara, I've unmuted you if you'd like to ask your question aloud or clarify.
Okay. Well, the last speaker just mentioned the fact that if the business operation were to be site-based, you had, right now we receive pre-vocational funds. We were under the understanding that we could receive community pre-vocational funds. Is that not true?
I do not know the answer to that question, and I think we'd need to seek precise input from OPWDD. Community-based pre-vocational services does have a workforce limitation, that's in there in terms of number of people supported. So again, I would specifically ask OPWDD for that clarification so you don't have an issue.
Any confusion. And will we be allowed, if we're not looking at a niche contract, are we still allowed to pay sub-minimum wage with the percentage of people that would be working in the integrated business?
When you look at the sub-minimum wage component, you need to really make sure that you're following all of DOL standards. And if you look at what has happened in the state of Ohio, there was a suit that was basically taken place. And where I caution you, sub-minimum wage is continuing right now for a period of time. However, you need to really clearly go through and demonstrate that the disability is really what's impeding all of the component to cause the sub-minimum wage. In the state of Ohio, the settlement that just took place that was not effectively demonstrated. And in fact, they had to go back and pay minimum wage and going rate to employees over a period of time that failed to follow all of those standards. So if you're confident that you're hitting all of DOL's expectations when it comes to hitting that sub-minimum wage component, at this moment it can continue. But I just caution you that you need to be very precise and accurate in doing that.
Thank you.
Yep.
So I think we covered that question that just came up. We currently have a 14C certificate. Is that the question that was just answered? Okay, we have another one. Why would one need to switch from pre-vote to community pre-vote? It will be highly scrutinized as to why the request to switch from site-based to community pre-vote.
The pre-voc, remember the site-based pre-voc right now has been capped. Again, the state may in fact open that door again under the integrated employment model, and I say might if your ratios are not at that level. Some businesses in fact can become a standalone business model. And if you look at some of your business components, you in fact could do a standalone business model. And if the numbers of employees that you need with disabilities is small enough, you could in fact do community-based pre-voc. It's really looking at what's optimum for the person and does that environment fit that. I think we can't start with should it be this pre-voc or that pre-voc. We need to start with what is the business, how many people with disabilities are involved, what is the gain for the person, and do we comply with the pre-vocational requirements and regulations for that business model that's set forth.
Nicole, are there any hands raised or any other questions showing up on your screen?
Nope, I don't have any additional questions.
Great.
I did unmute if, oh, okay. Erin Seeley has a question. She says, what is the best way, in your opinion, to include community pre-voc in the model and to pay them under 13C, 14C?
14C.
14C. And I'm going to unmute Erin so that if she has additional follow-up questions. So if you'd like to respond to that question.
Yeah, so my question is basically how do you feel is the best way to include the community pre-voc?
That goes back to your business that you've set up. Like let's say someone has a upholstery business that really only employs 15 people. Can you hit your threshold component? Does it stay integrated or not? And then does it hit the community-based pre-voc component? If you can really break this business out and keep it as a completely separate entity, you may have the opportunity to do community-based pre-voc. So you've got to look at all of the regulations simultaneously to really determine what works optimally. And one is having to do with the vocational service, and the other one really has to do with the business service. You need to look at both of those at the same time.
Okay, thank you.
Mm-hmm. I wish it could be straightforward and say do this or this or this. It's not quite that simple. It's looking at each line of business and saying how have you set yourself up and then where do the standards hit in reality. At the end of the day, all employees need to be kept and looked at the same, no matter what you end up doing, whether they're getting pre-voc as an additional support for them. That staff cannot be counted into the model component at all. So that's just something you need to factor in.